Airports in the Northeast were filled with long lines and frustrated travelers.
This is what the site looks like over at Terminal C here in Newark Liberty Airport.
The people you see behind me are United Airlines passengers with canceled flights.
There's a 9-hour line at the Newark help desk.
Last month, I made the unfortunate decision to fly United Airlines to Europe, and to cut to the point, it was the worst week of travel I ever had. And it's safe to say I won't be flying with them again. And before you say, I thought this was a finance account, not a travel one, why are you telling me this? Bear with me. While I was standing in line for the United help desk at Newark Airport in an absolute state of rage, I was scrolling on TikTok. And my entire feed was videos of people experiencing the exact same travel misadventure I was.
Come on, this is like the Disney World line from hell here.
And my gut instinct at that moment was to bet everything I had against United Airlines ahead of their earnings, especially when you consider the new delayed flight compensation rules that airlines need to follow. But when I finally got home and really thought about it, I came to realize that while it's not good that United had tens of thousands of angry delayed passengers, the reason that delays happened in the first place was that their demand was absolutely through the roof. And they overestimated how many passengers they could handle, or in other words, I should actually be buying shares ahead of their earnings, not selling them. And honestly, while I really don't want to buy shares in a company that put me through absolute hell, if my theory was right, it would at least be some sort of retribution for the inconvenience I had to go through. So after much deliberation, I bought 100 shares of United Airlines stock for $52. Fast forward to their earnings date, July 19th, and
United finished the second quarter with top-line record quarterly revenues of $14.2 billion.
Despite the mayhem, United had one of its best quarters ever, and shares shot up to $57, netting me a nice little profit. The reason I tell you that story is because there's two takeaways from it. Number one, don't trade stocks emotionally. In the heat of the moment, when I was adamant about my plan to exact as much financial destruction on United as I could, if I had followed through with that and bet against them, I would have lost money. However, after thinking about it with a clear head, I made the right decision. The second takeaway, and the one I wanted to talk about, is the concept of social arbitrage investing. What social arbitrage investing entails is spotting trends on social media and capitalizing on them in the stock market. So when I saw all the other videos of massive lines in the airport happening not just at Newark Airport but almost everywhere, I realized that the demand for travel is back and bigger than ever, and then bought shares of the airline. That's social arbitrage investing. And the best part about this investment strategy is that you can find these opportunities just by scrolling on TikTok, YouTube Shorts, or Instagram Reels. A perfect example is Abercrombie & Fitch. My feed had tons of videos talking about how great their new line looks and how some of their clothes were completely out of stock on the website. So sure enough, when they released earnings in May, they blew expectations out of the water and popped by over 50%. And we've also seen it go the other way, like with Bud Light last month or even Target before that. My point is, when you're scrolling on social media or even in person, you can make money by observing social trends and connecting the dots, and then buying or selling shares of the company in question. And the best part about this strategy, and the reason why it works so well more often than not, is the people who work at major banks and hedge funds that control the overwhelming portion of the market aren't usually going to be scrolling on social media and noticing these trends. They'll only figure this out when the company releases its earnings and surprises them, at which point the stock moves substantially and you can exit your position, hopefully at a profit. Full disclosure though, one thing I've noticed when researching this strategy is that it's not something that you want to force, but instead just be aware of it when watching videos and find these opportunities organically. But let me know how you guys feel about it and if it's something that can be done. As always, follow for more, and thanks for watching.